Hello everyone, this is Marshall Gittler speaking. I'm going to discuss the main issues facing the FX market in the coming week beginning the 29th of January. The past week was characterized by confusion over just what U.S. policy was towards the dollar. Let me clarify this. U.S. policy hasn't changed in years and it hasn't changed now. The policy is one of benign neglect. The U.S. does nothing to support the dollar, but at the same time, it doesn't do anything to push it lower either. Now, Treasury Secretary Mnuchin may have said he was happy to see the dollar fall, but that doesn't mean he'll do anything to make it fall faster. The whole thing is a big fight over nothing, in my view. Nonetheless, I expect the currency market to test just what Mnuchin is thinking by pushing the dollar down to see if they can get another reaction from it. If he continues to say he doesn't care, then that will be seen as a green light for further dollar selling. Very dangerous. This week, there are several major events in the U.S. Tuesday night, U.S. time, is Trump's first State of the Union address. Now, this speech is usually where the president lays out his policy priorities for the coming year. Trump's likely to talk about trade and infrastructure investment, among other topics. Now, given his recent comments about the NAFTA negotiations, I'd expect Trump to use the opportunity to congratulate himself on the progress made so far, rather than laying out any new ideas. Oddly enough, I think that could help boost the Canadian dollar because fear of NAFTA problems is one thing holding the Bank of Canada back from hiking rates. Now, Wednesday is the much-awaited first FOMC meeting of the year and the last meeting for Fed Chair Janet Yellen before Jerome Powell takes over in February. The market sees virtually no chance of a rate hike at this meeting, but considers a hike at the next meeting in March to be a virtual certainty. Now, with no press conference after the meeting, we'll only have their statement to go by. I expect the statement to acknowledge that inflation has moved closer to their 2% target, which may encourage investors to discount more rate hikes this year than they're currently discounting to move their forecasts more up closer to what the FOMC is thinking and thereby to support the dollar. Wednesday is also the ADP report, the foreshadowing of the key indicator of the week, the monthly U.S. non-farm payrolls on Friday. The ADP report is expected to show an increase of 175,000 jobs, while the payrolls is forecast to show 183,000. This would be higher than the 6-month average of 166,000, which you can see on the left-hand graph here, and would be a good figure, I think, that should also support the dollar. The market's also looking for an acceleration in the pace of average earnings growth. That's the graph on the right-hand side. That could be a sign that the tight labor market is finally feeding through to higher prices. And that would probably be even more significant than the headline NFP number itself. We'll get a variety of insights into inflation during the week, too. Monday is the U.S. personal consumption, personal income, and personal spending figures, which include the personal consumption expenditure deflator and the Fed's key inflation gauge, the core personal consumption expenditure deflator. That's expected to inch up slightly to 1.6% year on year from 1.5%. That's the green line in this graph. As you can see, it's slowly approaching the 2% target, which is likely to give the Fed more confidence in raising rates 3 times this year, which is what they're forecasting, not what the market is forecasting. And that may support the dollar later on in the year. We'll also get important information from Europe about inflation. Germany's inflation data comes out on Tuesday, and the EU-wide figure comes out the next day. Germany's inflation rate, the green line in this graph, is expected to be unchanged at 1.6% year on year. For the EU as a whole, the headline figure is expected to inch down, but the more important core rate, the red line in this graph, is forecast to inch up to 1% from 0.9% year on year. That's still well away from the ECB's target of close to but below 2%, but at least it's moving in the right direction. That could help to support the euro a bit. As for Britain, the main points this week will be probably the Bank of England Governor Carney's appearance before Parliament's Economic Affairs Committee on Tuesday, and the manufacturing PMI on Thursday. Thursday is PMI day internationally, when the final PMIs for the Eurozone and the US come out, the market PMIs that is, as well as the closely watched ISM Manufacturing Index for the US. So my forecast for the week overall is that the dollar will probably keep on falling because nowadays that's just what the dollar does. Also, as I said, I think the market's going to test Treasury Secretary Mnuchin's commitments and see exactly who in the U.S. administration really does speak about the dollar. The euro should keep rising as a result. The pound seems to be in an uptrend too. It's been gaining not only against the falling dollar, of course, but against the euro, despite euro strength. I think the market's revising its view on how terrible Brexit will be for the country, and that's pushing pushing the pound up. As for the yen, I can't see why it's been strengthening recently, except that the dollar is weakening. So I'd expect it to fall back somewhat this week, fall back on the crosses at least, if not against a weaker dollar. One point to watch this week is the Swiss franc as well. That seems to be a new focus of the speculative community. This is Marshall Gittler bringing you the outlook for the week beginning the 29th of January. Thank you for listening, and good luck with your trading.